There is blind justice, and then there is trading justice, so that you can finally afford to get that laser eye surgery. Not only will people find you more attractive once you ditch those old glasses, you'll be able to see your charts better. That's what we call win-win. Speaking of winning, it's time for a little trading justice. Brought to you by TackleTrading.com.
Welcome out to the Trading Justice Podcast presented by Tackle Trading. Tim, did you know we had a new sponsor?
I did not.
Well, you should have since you're a co-owner of it.
Okay, I should have known. Yeah. I didn't get the prep.
Oh, you did. You didn't. Yeah, I just kind of threw it out there. Guys, welcome out to Trading Justice. Matt Justice, my co-host Tim Justice. We got a special guest here today. Probably going to become a co-host eventually. We'll see where that leads into. He's got to wine and dine me a little bit. Noah Davidson, how are you?
Who's got to wine and dine who? It's a pleasure to be here.
Listen, I am a cheap date. I'm just going to say that. I'm a very, very cheap date.
I'd heard that.
Yeah.
I'd read that on the bathroom wall. Anyway,
yes. Did you see my number?
I did.
Oh, okay. Which one? Was it a rest stop?
Yes.
Oh,
yes.
No.
The Flying J?
Oh, no. I was supposed to take that down. Yeah, well, welcome out to the Trading Justice Podcast, everybody. We're going to talk a little bit about tackle trading and our new initiative here in just a little bit. But before we get into that, kind of the topics, we're going to start a new segment here, and it's called The Coach's Show. Is that what we're calling it? The Coach's Show?
We can call it whatever we want, but I think it's a good name. It kind of spells it out for what the intent and purpose of it is.
We're just on the fly here, guys. We're just kind of just completely on the fly. But it's basically the student segment, trader segment of asking questions, and we have 3 questions I want to talk about today to answer our students' burning desire to get financial knowledge. The first one, and I want to kind of talk to both Tim and Noah here. Both of them are just absolutely excellent option traders. And it comes from Eduardo. And Eduardo says, since we have been talking about earnings plays a lot lately, and you have even set some up for us recently, I would like to know more about how you choose the expiration for an inverted butterfly and an iron condor. Let's first start with the inverted butterfly here. Noah, if you could kind of explain what an inverted butterfly is for the audience.
Well, an inverted butterfly sounds pretty technical, and it's one of those things where for me, when I look at risk graphs and the different names of the option strategies, the picture is worth 1,000 words to me, is understanding what that is. An inverted butterfly is essentially a trade where we are going to, what we do is we buy the short-term options at the money, and we sell the out-of-the-money options and in-the-money options to create a credit. Because usually between selling the in-the-money option and the out-of-the-money option, between the intrinsic and the extrinsic time value, we'll end up with a credit, so that if the stock price moves and expires, if it moves to a higher price or to a lower price, the credit becomes ours to keep.
Good.
And it's a bidirectional trading strategy, which means at earnings, the real challenge is because earnings is a catalyst that makes stock prices move, and it can move them a lot. The option premiums, they build that implication of volatility in. The premiums go up. And one of the first strategies I learned as a trader was called a straddle. And I went to a seminar, and some guru told us that this was the holy grail that you can't lose. You can buy a call end, you can buy a put right before earnings, and if it goes up, you win. If it goes down, you win.
That's what the almighty guru said.
But then I couldn't understand why, when I went to do the trade, that it didn't win. It was a consistent loser for me. I'm like, well, this is the holy grail. What am I doing wrong?
Hey, Noah, can I stop you real quick?
Absolutely.
Because I had a very similar experience, but it was just like a year ago. And I was out on the road, and I was giving a presentation. I was teaching the straddle, okay? And the way I was teaching it was, okay, we got to put this on, 5, 6, 7 weeks ahead of time. And we're going to close the trade before earnings. Okay, right. So we don't lose all the volatility gain. And I had 2 of my team members come up to me, and they're like, wait a second, what did you just do? I said, what do you mean? And they said, well, we've always been seeing every other presenter basically say, yeah, you just got to buy a straddle the day before earnings and hold it through earnings, and you're going to make money. I said, what are you guys talking about? You'll lose money. You have to have the stock move 1.5 times the market maker move to gain on that trade. But that's the way a lot of, and that's the thing that frustrates me about some speakers out there, is they'll just teach these principles and they're actually harmful. And it really kind of leads me to believe that they don't trade that much.
Right. Well, when one of our great mentors, Gino Porra, he and I have had long discussions about this. The idea of that strategy dates back to very early .com style trading, and the idea of the earnings announcement making the stock price move huge during that time would occasionally and oftentimes beat the market makers' expectations, or essentially the efficiency of the market. So the way I look at it, and I do the same thing you do, is I understand that the markets are highly efficient.
Yeah, I was just going to say that.
Everything that's known or possibly knowable gets priced in to the stock and the options. And with an earnings announcement, if you are buying that straddle, you are buying the call at the money and you are buying the put at the money, the expected move is priced in and then some. So essentially, if you think that trade is going to win, it means you know something that the market doesn't.
You're basically saying you're better than the market.
You're either Martha Stewart, or you've got some inside information somewhere. You might end up in prison for that, because it's hard to be. The market's going to overestimate what the be just to make sure that they're on the safe side. They're a little bit like the house in Las Vegas. If you were to go try and place a bet on a football game, they're going to actually look at all the statistics, and then they're going to price in a spread. And if it's getting too unbalanced to one side or the other, they're going to widen that spread to make it more challenging for the average gambler to beat the house.
So in a nutshell, it absolutely does. So in a nutshell, you can't beat the market, and the market right now, from an option pricing standpoint, is probably the most effective and efficient it has ever been. Right. And you got to play the appropriate way. So coming back to the inverted butterfly here, we are making the trade right before earnings, because we do expect it to move and whatnot. So basically what we're doing is we're buying, let's say we're just doing it on the call side. We're buying 2 at-the-money call options, and we're selling an out-of-the-money call, and we're selling an in-the-money call. And the net result in that should result in some degree of credit, whether it's 8, 10, 12%, somewhere in that range. Now, Tim, let's bring you on for a second. In one of the evolutions in the options market over the last 5, 10 years has been so many expiration dates, so many strike prices, right? And to the novice trader, to the new trader that's just out there trying to learn like Eduardo is, how do you teach somebody what expiration date to select when there's so many to choose from?
Oh, I have a pen, Matt. It's too many options is the problem. You have too many options, and that it's they'll do those reports on consumers. If they have too many choices, they don't know what to choose.
They don't do anything.
They'd rather have 1 or 2 choices at the grocery store rather than 200.
Yeah.
Agreed, and I want to hear what Tim has to say on this, because this is a common sentiment.
Well, I think my job on the podcast is like quality control. So, number one, we have made an assumption to start the segment that people know how to send us email questions.
Okay.
As you just said, Eduardo had this question. I mean, if you're a listener out there and you're thinking, well, how do I get my question on the air, and how do I get Noah and Tim and Matt to talk about it?
So.
We got a couple ways.
Tim, is this a self-appointed
job?
It
is. I am very much self-appointed.
Hold on. There was 6 podcasts ago where we went for 45 minutes without dropping the website, right? And so Tim was like, it's my job, because Matt talks more than me. It's my job to just make sure he doesn't go off on tangents. Okay, so that's how Tim self-appointed him, this guru of quality control. Well, to come back, thank you, Tim, for that. We have a couple different Facebook pages. You have the Trade Justice Facebook page that many of you know, but you got our new one, Tackle Trading. We have a Facebook page of Tackle Trading. You can reach us at Tackle Trading on Facebook. You can also reach us at tackletrading.com. As well to do that, and obviously the Trading Justice website as well. So you can reach us pretty much anywhere. We are like an open book in every aspect of it. We'll try to get that a little more streamlined as we get more involved in the tackle trading side of things.
Yeah, and team@tackletrading.com is our admin email, and if you want to put in the subject line podcast, we'll take the interesting ones and we'll bring them on the air. But to the original kind of the conversation here, number one, if you're brand new at trading, you should never, before we really go into any of this, don't trade any of these strategies live until you've ironed out the details in paper. I think every mentor and coach will tell you this, give you the same advice.
No, absolutely.
Inverted butterflies and earnings trades can be tricky because it is about assessing volatility projections, and you got to learn how to do some math. And that's where, like, following the tackle trading playbook, and, like, you know, when you sign up at tackletrading.com, we send you an ebook. Those kind of guidelines can help you with some of the basics of strategy and all that. It is a lot of information. I mean, even for me now, you know, when you go into an option chain, my trained eye knows where to go, but I still remember looking at an option chain and having numbers and numbers and numbers and numbers, and it's like drinking from a water hose. My advice is follow a structure that's been predefined by another coach. The reason why markets will create option chains, Matt, like look at Apple and Google and some of these, they actually have mini options now.
Like 200-300 strike prices. Yeah.
For the first 4 weeks out, and then they have their standard options. They got options all over the place. And when you're a new trader, you kind of have to get past that noise and get down to a basic set of rules and strategies. In terms of the straddle versus inverted butterfly, I don't really think there's a big debate for most traders. The inverted butterfly is a little bit more consistent and easier to actually build into a profit zone. Here's where the trick is, and I actually had a trading lab on this last night, you know, where I was talking to some students about this, and I had a student who was in CMG recently. And what did CMG do on earnings, Noah? Do you know?
It moved. It moved wild.
A huge move.
70 points movement?
Yeah, 70, 80 points, and then it kept running. And because of the nature of an option, when it starts at the money and then it gaps or moves to where it's either really far out of the money or really far in the money, the nature of the bid-ask spread can open up and become less liquid. So, Matt, you tell me if you've seen this before. This trader who's new at the strategy is watching their profit number on their screen. And it's going down even though the trade is getting better, but they're not connecting.
Tim,
Why?
I had that on CMG.
Yeah.
You know, I had a very hard time getting out of my trade because the bid-ask spread was so wide because it moved so far. It would have been much better for my trade if it only moved 40 points instead of 70 points.
Well, and what you're forced to do sometimes is be really patient. You know, you can't necessarily get out of an 80 point in the money option with a 100 delta in 5 minutes. I mean, putting your offer out there to the market on one side of the vertical, then the other side of the vertical, you have to get creative, which is why it's not always best when you're brand new. If you're a new trader, like yesterday, Noah, we had a great podcast on just like converting from a 401k to an IRA and some of the basics. If you're a brand new trader, focus on simpler strategies. But if you've been doing this for a while, and who was it, Eduardo, who had this question?
Eduardo. Yeah.
So Eduardo, my advice is, and was his question on how to get out of them or how to?
No. And I'm going to wonder if I was wondering if either one of you were going to answer the question.
Well, I'll answer
the question
we should
was
probably repeat the question at this point in time, since I've gone and chased a squirrel or two.
Yes, both of you have went down the rabbit hole here. The question is very simple. How do you select the expiration date?
Oh, yeah. What I do is I build the credit in the order form, and then I flip from week to week to week to week to month, and I actually look at like 5 or 6 different choices right from the order form. Because in my broker, you can just do that with the drop-down arrow. You can kind of choose different months. And I look at the ROI numbers, and I flip it from call to put in each expiration. And basically, based on some of the rules I have certain metrics that I'm going for. You know, that if we were in like a one-on-one coaching session, I was working with somebody, I'd walk them through the guidelines. But I have a minimum credit I'm looking for, Matt, for my deltas. In my probability, I just follow those rules.
So would you say if your minimum credit you're looking for is 10%, you will price out, you know, the closest expiration date and then go out in time until you get 10%?
Yeah, and if the earnings is on Monday or Tuesday, I'm much more willing to play the expiration that is that Friday. If the earnings is Thursday night or Friday morning, there's some gamma risk there, and those can get tricky. So a lot of times I'll go to that next week.
Yeah.
So I don't necessarily like to have it one day sensitive.
Okay.
So can we come back out and say we're searching for the best option when you're looking at building these out? I do the same thing. I compare and contrast different constructions of the trade and find what I'm looking for is that sweet spot or the baby bear, not too tight, not too loose, that just right, which it can be elusive. But let's step back. Let's define would you say that this inverted butterfly is a long-term strategy or a short-term strategy?
I think it can be played both ways, and that's what I was going to bring into the table here into the discussion. One of the things about the inverted butterfly that I find one of the reasons why I like the trade so much is it allows you flexibility in management. And if you're real short-term, even 3-4 days to expiration, you don't have a lot of management time. If you're 3 weeks out, time decay is going to kill you if you keep some of those long trades, for example. So I think what Tim said is in terms of finding the sweet spot from an ROI standpoint, but also give you enough time for trade management. What I've found on the inverted butterfly is if I got anywhere between 15 to 30 days in time, it gives you a really good sweet spot from an ROI standpoint and enough time to manage the trade.
I think one of the important things about this strategy or strategies in general is this gives traders a way to play earnings. And, when you're new, one of the biggest challenges is how do I deal with the earnings report? Well, there are actually strategies like we're talking about here where you can take advantage of earnings and you don't have to just avoid it. And whether it's the inverted butterfly or some other version of 9 different spreads that we could talk about, you want that tool in your toolkit, so that you can come in. You want that play in your playbook that we use that phrase at Tackle Trading in the playbook. And you want to have an ability to approach earnings, play it, and manage it. My personal opinion is very few of them should be long-term positions, but that's just an opinion. That may not be the group's opinion.
You might close this trade right after earnings. I mean, you might close the entire trade right after earnings. Let me just give you a quick example. Last quarter, I played an inverted butterfly on Netflix. And when Netflix gapped in earnings last quarter, it wasn't that much. It wasn't kind of what I was kind of expecting the gap to be on Netflix. It kind of gapped. It went up a little bit. It didn't beat the expectation, but I had to put inverted butterfly. And immediately after the gap, Netflix started selling. And so I closed the trade on both those short put sides, and I kept the long put option, and I held it for only like 3-4 days, and I made a tremendous much more money on just holding the directional put option just for those 3-4 days than I did on the put side. And so that's why I said I like the flexibility in trade management, being able to read what the gap does.
I'd agree with that. Absolutely. I think what Tim said earlier is when you're new to trading and earnings creates a challenge for traders when you're first starting out.
It's difficult.
It's wise to actually avoid earnings because of your lack of knowledge. You don't want your enthusiasm to get ahead of your skill set and your knowledge. And so when I first started trading, I didn't even know what earnings were, and I learned about earnings the surprise way. I would just I became a technician, but I didn't even understand how quarterly earnings affected the stock price. And so I was always a little bit surprised when occasionally I would win or lose because I was ignorant to the fact that there was an event that could change sentiment and prices very quickly.
Yeah.
And so I learned very quickly that when earnings comes, that could be like scary, like a hot stove. I don't want to touch that. So I would exit trades prior to, and that would create these several weeks during that earnings season where I'd had a hard time finding trades. And it wasn't until I actually worked with a option specialist mentor who actually taught me earnings specific strategies that I could then implement. Because when you're trying to trade for a living and trying to generate cash flow and income, and you get into that earnings season, if you don't have a strong enough repertoire, a big enough playbook to have a strategy for every part of the market, every stage or condition that the market can throw at you, you're not going to have the consistency you want to create the cash flow you need.
And also, you got to learn how to approach earnings from whatever type of trader you are. Whether you're a long-term trader and you buy protected put options on the earnings, or whether you're an aggressive active trader, you can't just sit out of the market for 3 months every year. You can't do that. You have to learn how to appropriately trade earnings. And so when it comes to strategies like the inverted butterfly, that's one of our go-to ones. It's a conservative strategy that takes advantage of of an expected big movement in the market. It allows you a lot of flexibility. So in a nutshell, Eduardo, on the inverted butterfly, what we're saying is price out multiple different expiration dates until you get that sweet spot right around a 10% credit on your margin requirement and enough time frame necessary to make adjustments. Typically, that'll be a couple weeks to 3-4 weeks in time frame. What about the iron condor on an earnings, guys?
Matt, before we move on to the next one, I just want to kind of come back and talk about, it's not just the pricing and the ROI. Mm-hmm. You've got to compare that to the stock chart's volatility, like how much the stock price moves. Look at the previous earnings announcements last year or 2 years and see how big the typical gap is. And the inverted butterfly, I would kind of like it unto throwing a ping pong ball into a cup from across the room.
Isn't that called beer pong?
If you've ever played beer pong and you're trying to throw the ping pong ball into the cup, the width of your inverted butterfly, there's risk, and the risk is if the ping pong ball lands inside the cup. Mm-hmm. And the area outside, so the way a inverted butterfly wins is if the stock price gaps up above the strike price, or if the stock price gaps down below the strike price, you'll win. So you win if it goes up, you win if it goes down. Where the risk is if it gets stuck in the middle, and the smaller the cup, or the ping pong ball, the area that they could fall in that price, the more likely it is that you're going to win. So if the size of the butterfly, the difference between the break-even points is too wide, the likelihood of the stock landing in the middle is where your risk is. So,
kind of what my rule is on that, because you're so right. If we have an expected market maker move that have $20, okay, that's what is built into the price action. That's what the market expects. Typically, the wings that you want to sell, the in-the-money option, the out-of-money option, I like to cut that by half. So I'd like to do a 10-point wing. If it's 30 points, 15 points, 40 points, 20 points. So that's typically what I have found will give you that sweet spot.
Yeah, and so the smaller that area, the easier it is for price to move outside of that range. And it's typically going to be near the money, right at the money. And so it's unlike beer pong where you only win if you get it in the cup. This is you win when it's out of the cup. And the bigger, the smaller the cup and the bigger the area outside those wings, the easier it is for you to win.
Absolutely.
So,
absolutely.
Yep.
All right, let's move on to the iron condor. Just because we spent so much time on the inverted butterfly, I'm going to take this one on Eduardo. On the iron condor, just for the exact opposite reason on the inverted butterfly, we take half the market maker move, times that market maker move by 2, and then just price out different expiration dates, the closest expiration date you can get to get at least twice times the expected market maker move, and that's going to give you a good range to sell on the iron condor. But like everybody says here, guys, you need to virtual trade these things for multiple different quarters before you to feel confident in getting out there in the live market. I want to go to another quick little question here, so give me 1 second. I'm going to get the next question. The next question comes from an intraday trading perspective, okay? And so I want to throw it out to both you two. Currently, this individual, Todd, comes from Todd. He's been doing a lot of swing trading, okay, a master trader type techniques, retracements, breakouts, focusing on day charts. And he's trying to get into day trading currencies, stock, futures and whatnot. How do you change? What do you typically? And I want to ask Tim first, and then we'll come to Noah. Tim, what time frame of the chart do you typically focus on when you are conducting day trading?
Well, I wouldn't say there's one, but I'd say if there was one primary one, it's probably a 5-minute chart. The way that I believe intraday charts and timing, because I get the question all the time, I think of it like a magnifying glass, and you move it in and out from your eye to get a different perspective. So bouncing from a 1 to a 5 to a 15 to a 60 to a 4-hour chart to me makes sense. And so as you're trying to find that perfect balance, I usually, after I've looked at a few, I'll end up back to a 5-minute chart. I look at that one quite often.
Awesome.
So that's mine.
Sweet.
I would come back and say my trade setups, even my intraday trade setups, in my case, are always set up on a larger swing trade pressure. So I would start out with the big daily trend and condition. Then as I drill down in, like perhaps maybe I'm focusing on an area of support and resistance from the daily chart, then as I focus down on the smaller time frame looking for triggers and trade management, I will jump to a 30-minute time frame, and I go to 30 minutes because of that weird little half hour where the market opens at 9:30 Eastern and then runs till the close. So that little 30-minute increment, when you jump to an hourly chart, what you wind up with is it kind of skews the little time frame a little bit with that 1 hour because it doesn't have data.
Yeah, the majority of the movement happens early.
So just out of habit, I've gotten into the 30-minute time frame, and then from there I'll drop down to 15 or 5. And what I'm trying to assess is what are the other traders thinking? And I would look at it from the mindset of the longer term investors. Well, they're not going to take action on a daily basis, but I have to understand what they're doing if they're holding or dumping. Then I look at the swing traders. Are they in this scenario where they're more likely to want to buy or sell? And for me, it becomes a game of mechanics where the market's one part emotion, but it's also one part mechanical because of the way people trade with stops. And focusing down on those time frames, on the smaller time frame, allows me it's a picking of a trigger and a target and a stop loss where I can play around with the entry and exit on the day trader time frame down on 5 minutes or 15, like Tim said. But there's a larger pressure going on where the swing traders are going to join in on that move because of the way that they trade their stops, their confirmation points.
And I think one thing you said is very wise in the sense that there's different time frames and different traders are focusing on different time frame on the chart. And if you're going to be a successful short-term trader, whether it's a swing trader or a day trader or even a scalper for that matter, you got to understand what the other traders are thinking in their time frame as well. When it comes to day trading, obviously I like to trade in the currency market, forex market cycle, the 24-hour cycle there. But in terms of the specific time frame, I typically will focus on a 15-minute chart just to get the trend identification, pattern recognition down. And then when I'm ready to process the trade, I'll drop it down to a 5-minute chart to kind of pinpoint the accuracy of that.
And I will come back and say one of the most common mistakes I see new traders make is getting caught up into 1 minute and tick charts and overthinking it. Those 1 minute and tick chart time frames are only going to be effective for scalpers with large sums of money.
Yep.
So if you're trading a multi-million-dollar portfolio and you're looking to scalp pennies to create cash flow, then fine, go down to the tick chart. But that will drive you insane.
But if you have one contract on Apple,
yeah.
Okay.
15 minutes. You don't even need to go down. You have no business being on a 1 minute chart.
None. And every one of us have seen that with new traders. Their tendency is always to lower the time frame when what they probably should do is to extend the time frame and look at it, because the more time frame you look at, it's going to be easier to identify the true trend. And that's what, when I'm day trading, I'll focus on a 15-minute chart to get a better idea of the overall trend. When I'm ready to process the trade, I'll drop it down to a 5-minute. But even myself, and I never look at a 1 minute chart. I mean, that's just insane to me that you can't get a good read on it. It's too volatile, it's up and down, and it's getting triggered for a variety of different reasons.
Right.
So,
and a doji on a 1 minute chart is not the same as a doji on an hourly chart.
No,
there's a huge difference.
There's a big difference there.
In those signals, and support and resistance on 2 minute time frames are not the same as support and resistance on hourly time frames. So I would say that the cautionary tale here is don't get caught up in the just minute fluctuations. It will drive you crazy.
And especially if you're new to day trading, I would focus more on longer time frames. It's taken all three of us a long time to really master the art of technical analysis. And, now that we have, it's fairly easy to focus on a 5-minute chart and be able to filter through the nonsense on it. But when you're new to trading, it's going to be very difficult to look at 5-minute charts and be like, oh my goodness, this is the trend, that's my trigger, this is my trigger. And so, maybe if as a new trader, new day trader, whatnot, maybe you focus on a 60-30 minute type segment where you're looking at your trade identification on a 60 and you drop it to a 30, or you go 30-15, 15 or 5.
Right.
But right now I do really like the 5 and the 15 minute. So, okay, now that was the two questions we have. Hopefully we can get some more for the next podcast. Let's shift up focus here, guys. The major topic of today, and we just have an absolutely massive week in the marketplace. economic reports and whatnot. Tomorrow, we have two major economic reports. The first one is the GDP report. The second one is the FOMC policy statement, which obviously we're going to spend some time talking about what the Fed is doing right now from a quantitative easing perspective, what they're doing with their curtail, how they're unwinding kind of the drug-addicted market and whatnot. But let's talk about the advanced GDP number. Why is the GDP number important from an economic perspective? GDP.
Well, first of all, it can adjust backwards from what I understand. So they can even go back. I know there were some numbers that they're still wondering about the first, second quarter. But one of the reasons it's important is it's the standard measurement for economic growth in the overall economy. Mm-hmm. It's not about stock market prices. It's about economic expansion. The way that we define recession, and what's happened with the Fed is they have taken over the role, either given to them or just usurped. There's some debate about some of that. They've taken over the role of making sure everything's kosher. You know, they're like the hall monitor, and they're making sure everything's growing, everything's under control, and that the economy continues to move forward. It is a data point, and it can affect the Fed's decision-making process. I doubt that they don't already have those numbers for tomorrow. So I don't think it'll affect the Fed themselves tomorrow, but over time is how it really impacts their decision making.
Mm-hmm. When we look at the GDP number, let's make sure everybody understands what it is. It's gross domestic product. There are 3 GDP reports on a quarterly basis. You have an advanced, a preliminary, and a final GDP number. The one tomorrow is the advanced GDP number. It is the first report we get, and it's typically the most important one because the next ones we already have kind of where it's at. There's going to be some revisions to it like Tim indicated and whatnot. But there are 3 reports in the GDP, and they happen every month. The first one, once again, is the advanced. The second one is the preliminary, and then the last one is the final GDP number. So tomorrow it's going to have the greatest impact. Now, when we looked at the previous quarter, this was for the first quarter of the year, we had a negative 2.9% GDP number. Now, a lot of that first quarter, it was basically, the excuse was, and I want to hear Noah's take on this, the excuse was the reason we had such a dramatically negative GDP number, which negative 2.9, one of the worst ones we've had in a very long time, Noah, was because of such a harsh winter. Do you buy that as an excuse?
Well, excuses, everybody has one. They usually stink. I can't remember how the saying goes, but there's always a reason behind whatever it is. And, that's conjecture, in my opinion. It just comes down to production was down, people weren't spending as much money. And there's a general psychology of consumption, and then people will pull back when they get overextended. And they'll start scrimping and saving and tightening their belts. So you kind of have to look at that. There's an expansion, contraction, typical cycle that's constantly going on, whether it was cold outside or they just wanted to save some money and didn't go out and stimulate the economy like they were expecting. Is it a sign of a bigger problem? Mm-hmm. Well, I would say, in my general opinion, the markets are being moved more and more on the news and statements, the policy statements and the news, where what used to be really important, like the price of a commodity, for example, traders have actually started to put more emphasis on the talk than they have put on the content and the actual numbers. There's been a huge shift in what's moving markets, and I think that's very, very interesting. I just read a huge article where they downgraded the importance of the price of a commodity like oil. So if the price of oil goes up, doesn't that affect the price of everything?
Yeah.
And that used to be something that traders would look to as just a hardcore important indicator that if you could anticipate the prices of the commodities, you could then understand how that would affect the price of the GDP, or how the strength of the dollar could affect the GDP as far as like imports and exports go. And what's been happening is there's been a shift in focusing on that information because it's being overpowered by the talk, and the talking points by the Feds, for example, would affect the price of the market's indexes, the strength of the dollar, or the individual stocks themselves as they react, more so than these hard economic numbers. So I think it's a very interesting place that the market's evolved into, where that these little announcements become so critical, and it's not even the numbers they put out, Matt. It's the reaction of the traders, the knee-jerk reaction, the subsequent reaction, and it's the emotion of it all. So, in my take, the numbers, they've been manipulating and fudging them and kind of making them look better than they are all along. And then, the actual talking points. So when the Feds talk, it's not what they're saying, it's that they are saying something and people react.
Okay, so we got this GDP number tomorrow. Do you think that with the inclusion over the last 5 years of the high-frequency traders, do you think that initial reaction to these reports have thrown off kind of what they truly do mean for the health of the economy?
I think they have. I think that the numbers themselves, just like anything else, you and I, we've all evolved as traders. Fundamentals analysis is slow-moving data, and information and technical trading is fast-moving data. And I think that the general evolution of the market has moved from longer term to higher frequency. And all you have to do is go look at the volume on like a major index or major ETF or something like that over the last decade. Last 10 to 20 years, trading volume has gone up immensely, and it's not that there's so much more traders. There are, but it's the higher frequency models.
It's the transactions. I mean,
yes,
just even 10 years ago, 2 billion shares traded in the market was high, and now I think it was a high number, but there was 2 Fridays ago, it was like 7 billion shares were traded that day.
Well, and I don't know if my numbers are accurate, but I've seen several estimates that say over 80% of all transactions are high-frequency robots.
We had, Andrew Cameron very well, the same way
yes.
we do, and we had him on one of our podcasts. I think it was podcast number 4, episode 4, and he knows a lot of high-frequency trading systems, and he's an institutional trader now, and they use high-frequency trading systems as well, and he was telling me the number's over 90%. And so your 80% number, I think, and I thought that was a little high myself, but I would not be shocked to see the number being above 80% with high-frequency traders. They're the ones that are creating a lot of the liquidity on a daily basis in the market.
Oh, absolutely. Well, what I would say, what I've learned about that is the patterns and the cycles that have existed in the market all along are still there. They have just simply sped up. And so, what would normally take weeks to roll out in markets of days past can now transpire in minutes as the computers are firing the same algorithms, because those algorithms are programmed by people, and the people program them based off of the market conditions.
Well, so here's kind of what you're going on there. The advanced GDP number tomorrow, and I want to get your guys' take on this, both Tim and Noah. It's forecast to come in at 3.1%. If the number comes in above 3.1%, the market will typically respond to the upside, because that's positive for the economy, positive for the market. If the market comes in underneath 3.1%, it's typically a negative. Now, we don't know exactly what the number is going to come in. We don't know that until 8:30 tomorrow, and then there's an actual hour before the market even's open. But there's already a market open. What market is already going to move before the stock market opens up?
Well, there are two.
Yeah, you got the currency market, right? Which other one?
Futures.
The futures market. Now, I was talking to a high-frequency trader, and they were telling me that basically those numbers are already programmed into the algorithm. And so if the number automatically comes in above 3.1, what those frequency traders are going to do is they're going to trigger buy orders. Okay, that number, it's just the number that comes into the program. They're going to trigger buy orders. If the number comes in underneath 3.1, they're going to trigger sell orders, and then they're going to reevaluate the situation.
And then the orders trigger orders. The technicals trigger the technicals.
Exactly.
The stops trigger the stops. It pushes prices into a fast knee-jerk reaction. And Noah, I think this is a homework assignment for everybody who's listening to this podcast, is to get in front of the computer and watch the major indices of the dollar index, the S&P futures, during the announcement release, and see the price action.
Watch the movement.
Move. And what you'll see is they have these kind of little personalities where you'll get a really quick reaction, a revision, and then the dust settles, and then it'll pick a direction. And what I've been noticing lately is that the market is in this kind of strange place where it's not sure whether it's coming or going. We're nearing these all-time highs, and they need to see signs of strength to want to continue to buy. And if they are not seeing the strength. They're worried about the sell-off. They're all poised to pull their money out of the market. And there's a lot of what I would refer to as wait and see kind of mentality for the big fish. The big players are always looking to either put money in, keep it working, or pull money out and keep it safe. And these little news events, these GDP numbers, these economic reports, Fed statements are kind of the catalyst that they're looking for. And they start that reaction, and then it's a matter of how the reaction then spreads. So it's fascinating to watch, and you have to sit in front of a chart. And I do this every time you get a chance to sit in front of the charts and watch the markets after the Fed speak. Watch the markets after the GDP.
You said something just a moment ago where you said, in days of past, right, where the market was a much slower market than it is today. Used to see these reports take time to build themselves into the price action. What would take days or weeks of days past now takes 30 minutes to 60 minutes to price itself in. And then you typically see, the initial movement, like I said, a counter reaction, but then it typically will follow the same direction of the initial reaction. It'll just slowly, move in that direction. But it really is an amazing dynamic to see what these high-frequency traders have done to the economic reporting system, because it's not the same as it was in our father's market, so to speak.
Newspaper reports take days to get out versus the flash crash. Look back to 2010 when you get all those computer algorithms responding the same way, and they still can't go back and tell you why that happened. And in theory, they've got safeties in place, but that's the kind of reaction that the market can move prices quickly.
If all those high frequency traders trigger in the same capacity and it triggers order after order after order, you're going to see crashes like that. And I heard their excuses the same way you guys did. But let's shift topics to the most important economic report next tomorrow, and that's the FOMC. Tim, I want you to talk to the trained justice population out there about why the FOMC is so important in today's market environment.
Oh, I've been doing this 10 years, and I still confuse whether the letter F is free or federal. I believe it's free open market committee, right?
It's supposed to be.
It's federal open market committee.
Is it federal? See, yep. The FOMC, the body, the committee, when they come together, every bit of money that's moving through our markets is being dependent and based on the idea that the Fed is going to continue to prop up the stock market through their bond purchasing program. I know they've been tapering. I don't want to go off on it because I don't want to put anybody to sleep, but I'll just go off on my opinion about why it is important and address what you talked about specifically, Matt. They're driving the car. Okay, we have to have faith in them that they're going to stay awake and get us to our destination. Some of us don't believe in their inherent ability to do that. Institutions and investment banks are definitely in that car with the Fed, and they've been on this road trip now for 5.5 years. It'll be 6 years now in March of 2015. There's a lot of talk, and I'm the kind of trading nerd that I actually read the Fed minutes and I go back, when they come out weeks after the Federal Reserve report, when they have the meeting, and I'll read through the minutes and I'll look at their economic data and I'll try to tap into their thinking and their logic. And it reads like an Orwellian novel almost. It's just ridiculous the way they phrase things, the wording they use,
lawyers,
the lingo they use to intentionally confuse the public.
Yes, it's all smoke and mirrors.
It's just a bunch of hacks.
I just want to know, is Janet Yellen single?
She is one. What did I say, Matt? She's a looker.
She's a looker.
I think she's very handsome, Noah.
She is handsome. I find myself strangely attracted to her. Anyway, go on.
Okay. Before we go off on how cute Janet Yellen is, I want to talk about kind of what is happening in the Fed right now. And I want to get both of your take on it, because the Fed has been propping up the market for 5 years now. They've printed $4.7 trillion, put it into the bond market. There's a question about how they're going to unwind that, and we'll do an entire podcast about that down the road. So we'll save that unwinding of the balance sheet down the road. But the reason they did it in the first place was to stop the bleeding in the subprime market. And now the market is just, they've literally propped it up for 5 straight years. Now, in December of this past year, December of 2013, the Fed started a curtailing, a tapering of their bond buying program. They've had 3 rounds of quantitative easing, not including the dollar swap and Operation Twist. The first round, after it ended, the market immediately responded down. It's like the Fed literally just Cold turkey, we're no longer putting $65 billion of money into the market. We're done. Quantitative easing, too. They cut cold turkey. Done. Market responded down 18%. This third time, I think they wised up from it. And in December of last year, Bernanke, before he resigned in early this year, he announced the tapering, of which every 6 weeks they are curtailing $10 billion a month. And kind of what I think about that is like the market is on drugs. They're a bunch of drug addicts. And when you pull a drug addict off the drug, you can't do it just right then, right? Because if you pull a drug addict off the drug, what's going to happen to the addict?
Well, it's like, I think what we're talking about here, Matt, is an economic methadone clinic.
Yeah, exactly.
I would actually
Breaking
say
Bad, baby.
That absolutely. The free money is a drug, and I kind of go back to, I don't know if you guys read that op-ed piece in the Wall Street Journal a couple of months back like a year ago. Andrew Huszar talking about whether or not all the money, the stimulus packages, the quantitative easing actually was effective in the fact of the GDP numbers. Did it reflect? They put in over $4 trillion and got a 0.25 bump in GDP. So $4 trillion, they turned $4 trillion into $4 billion of growth.
I think about that for a second, because what Huszar said was that have we seen the GDP, exactly what you're saying, have we seen the GDP growth match what the Fed has done from the $4.7 trillion? And we certainly haven't, in no capacity. We printed $4.7 trillion for a 0.25% bump in GDP. That's insane. But yet
it
now,
was very ineffective, very ineffective, and that's going to be the cost. The cost of that's inflation.
Oh, absolutely. But what's happening now is the Fed, and Bernanke specifically, tied his legacy to this. I think the Fed knew that what they were doing wasn't actually impacting the economy. I think it was just propping up the market. And now you're seeing the Fed curtail out of the market, trying to subside the pressure to the downside in the market. But what was seen in the market over the last 9 months since this tapering is the market has started to slow. The Russell 2000 is already double topped, and so it hasn't priced itself in the same way it did in QE1 and QE2, but at the same time, you're starting to see slowing momentum in the marketplaces, and the question becomes, when the Fed is out of the market, where does the market go from there? But before we get into that, where does the market go from there in October, is there a sense that the Fed is buying time for Wall Street to reallocate positions?
Absolutely, Matt. I've followed this, and it's for me, it's almost like investigative reporting, trying to figure out what's really going on, and figuring out what's really going on behind the curtain. Mm-hmm. And for me, it's kind of fun to look at it, and I kind of a conspiracy theorist just because I think it's a lot more exciting than regular life. But what's been going on, and what the Huszar statement was really about, is he was apologizing to the American public because he referred to the quantitative easing and all this as the biggest backdoor bailout of Wall Street banks. Mm-hmm. And what it comes down to is the whole bond buying program comes down to how banks' books are managed. You go back to the subprime meltdown, and all these loans that were created were put on these banks' books, and they have these low to no interest rate loans, adjustable rate mortgages, higher risk mortgages, et cetera, essentially bad loans, bad debt. And the banks have these on their balance sheet. Well, by law, banks have to have a certain number of bonds on their balance sheets. They have a certain number of loans, and according to the fractal reserve, they can't go make new, healthier loans for the banks unless they clear other loans off their balance sheets. So what the whole bond buying program has been about is freeing up the bank's balance sheets to survive, those stress tests that they've been running. Mm-hmm. Is the stress tests are kind of designed to see, will the financial institutions survive an economic, flash flood, if you will, and the stress tests. And so in order for the banks to become more profitable, they have to move these loans off their books, and they've been putting them onto the Fed's balance sheet. Mm-hmm. And the Fed's balance sheet has gone since 2010 or so. They've put how many trillion? $6 trillion.
Honestly, the ones that we know of, right? Right. It was like 1.5 trillion in 2011. We're now up to $4.7 trillion.
Right, and it comes down to to that federal funds interest rate. That right now it's less than 0.25%. And, banks, to be profitable, to be healthy, they need to have the type of loans on their banks that actually pay interest.
Mm-hmm.
And, people want to hold the currency that pays the most interest. So when you look at this is a huge, big global it's a systemic thing. It's all throughout the whole entire system of what dollars are worth what pays interest, what banks are safe, what banks are strong, and are these banks profitable? And the whole situation of stimulating the economy and putting all this money out there has been a little bit of a sleight of hand to keep the banks healthy, to keep their balance sheets, freeing them up so that it can now raise interest rates. So what they're positioning to do is raise interest rates so that they can then issue new loans at higher rates of interest, which will be better for the bank's profits.
Well, let's look at that for just a second. Let's from a QE perspective. When you're talking about what QE, who it helped, it obviously helped the banks. And who does it hurt when we're trying to buy the banks time to reallocate? Who ultimately gets hurt in this?
The consumer, the U.S. taxpayers?
The U.S. taxpayer, the U.S. consumer, the mom and pa in a 401k, they lose 50% of their value in the next crash, and they wonder what in the world just happened, and yet the Fed knows this is happening, and yet nobody is warning anybody out there. And that's one of the reasons why we do what we do, guys, is to get the information out to the populace so that they can make rational, logical decisions over their money, over their financial future. And when we look at kind of just the inflationary impact, let's talk inflation and what the Fed has done. You mentioned that one of the risks to QE isn't not just the downward movement in the market, but inflation itself. Now, Tim, come on here for a second. Talk to people about what really inflation is.
Oh, well, I mean, it's the rising price and cost of living in your bottom line. We feel it over time. We don't always recognize it right away. It's less purchasing power from your currency, is what it comes down to. So you either deflate the currency, you increase the price of goods. Like Noah's talking about, commodities haven't necessarily gone up in price, but the value of our currency has gone down. With some of the global trends we look at, even outside of the Fed, you've got to concern yourself with where's our currency value going to be in 5 or 8 or 10 years. I don't think it'll be higher. I don't think the U.S. dollar is bullish right now, considering its role it's going to have in the petrodollar moving forward and all those kind of things. But when it comes down to inflation, I mean, we all feel it. You've seen those things where it's like, this is what $100 in groceries would have bought 15 years ago and 5 years ago and today. I mean, I went to the grocery store the other day, Matt, just to buy stuff for Sunday dinner for my family. Just 2 kids, my wife, myself, staying at home. $65, and that's from the store. And I'm not buying lobster. I mean,
and that's precisely why I eat out and go to a restaurant. Because if I'm going to spend $65,
you're going to enjoy it.
It's not going to spoil in the refrigerator 2 days. I'm just kidding, but that's exactly what it is, Tim. We all have very nice, lovely incomes. I'd say as far as like looking at the mainstream income, what's average income in the U.S. household income is what, $50,000, $60,000?
$56,000, $60,000.
Yeah, like 2-income home.
Yeah.
Well, I honestly don't think I could live on that.
There's no way.
And that's not with a big fancy house and fast sports cars. That's just paying the bills.
Yeah. There's no way. I have 4 kids.
Right, exactly. And 4 kids, 2 kids. They eat and they go to the grocery store, and a gallon of milk is now $4.
It's more than gas.
Yeah.
That's amazing. I want to give you a quote from Husnar's op-ed piece he did in the Wall Street Journal. And he says basically after QE2, okay? He says after a few months later, after a 14% drop in the U.S. stock market and renewed weakening in the banking sector, the Fed announced a new round of bond buying QE2. Germany's finance minister, Wolfgang Schäuble, immediately called the decision clueless. Now, this ties right into the conversation that we're having on inflation and the Fed. Why would Germany's finance minister, Wolfgang Schäuble, call the decision clueless by Ben Bernanke and the Fed?
I'll give you 50 cents if you try to pronounce his name again.
Schäuble.
What is that?
That's how I'm saying it, Schäuble.
Schäuble. All right.
I thought you said trouble.
Schäuble.
I did too at first.
Okay, go on.
Wolfgang trouble or something. Anyway,
SCHA with 2 dots above the A, UBLE.
But now do it with a German accent.
No, I don't have a German accent. I'm Norwegian. I'm Welsh. Okay, anyways, coming back to this, you clowns. Why did Germany's finance minister call the decision clueless?
Well, first of all, I mean, Germany calls everything clueless outside of Germany. You know how many negative opinions I hear them write up about the ECB board and what's going on even
Because
within
the
the European
ECB
Union.
is doing the same thing the Fed is doing.
I understand. Yeah.
I mean, to me, guys, when you haven't been through a hyperinflationary scenario, you don't have the same mindset, mentality, or level head that you do if you have been through that. And Germany's been through it. I mean,
the U.S. has never really been through a currency crash or a hyperinflationary environment.
As Germany did.
That's been equal to that of other countries like Germany. You look at the outcome or the effects of a hyperinflationary environment and a crash. That's one of the things that contributed to global war. Back in the day was the currency crash.
Nobody reacts more crazy than when we talk about money. Right. And when you look at it, let me give you a couple of key points in a hyperinflationary. Number one, massive debt. Okay. Number two, an economy that does not support spending. Number three, you have printing of money. Okay. Now, do we have massive debt in the U.S.?
I think we're the best at it.
We
lead
really
the world in
efficient
consumer debt.
Okay. Have we been printing money?
Technically, yes.
$4.7 trillion.
Most of it's digital.
Okay. Well, let me give you a couple ratios in Germany. In 1914,
he got you, Matt.
Yeah,
He got you right there. Have we been printing it? No, we've been adding zeros and ones to our spreadsheet.
Okay.
And printing it too.
And printing it. Okay. Now, in 1914, the German mark to U.S. dollar ratio was 4-1. In 1919, we had the Versailles Treaty, of which we put massive debt upon Germany because apparently they lost the war.
They just barely paid that off.
I didn't even know they had paid it off yet.
They just completed paying off their debts from World War I.
That was 1919. We put the Versailles Treaty on them.
Right, and they just have paid that off in the last 2 years.
Wow.
They finally paid off their last World War I debt. Now they're starting on World War II reparations.
Well, let's give them another 150 years. Maybe Bitcoin can pay it off for them.
Exactly. Well, that's why Bitcoin exists.
For Germany to pay off their debt?
Well, no, just the circumventing of the economic system. The monetary system, the manipulation of the monetary system takes the value of your money out of your control. So saving your money is actually, in my opinion, losing your money. So it changes the conventional wisdom is save your money, don't rack up debt,
If there's one guarantee,
save it for retirement. You can't save at a rate faster than inflation.
If there's one guarantee I can give any consumer out there, go look at your money in your checking account, go look at your money in your savings account, and realize it's the worst investment you have. It's guaranteed to lose.
Saving?
It's saving money, guaranteed to lose.
So what should I tell my daughter because she's a saver?
Tell her to invest.
My oldest
Tell her to
daughter,
spend.
Matt, she when she finds money, she puts it in her jar. And she has this huge jar up in her bedroom. It's probably 12, 14 inches high, and it's full of silver dollars and $20 bills.
Basically is rummaging through your drawers and checking your pockets. Is that kind of what's going on?
Yes. She's cleaning up.
Hey, Tim, you know what you tell her? You tell her, let's go to the store, let's buy it, let's buy some lemonade stuff, let's put it into a business. We've talked about this.
Yeah.
Savers or losers. Get it out there, get that money working.
Yep.
She's
In fact,
only 5. Get it working.
The entrepreneurial spirit is what I try to teach my kids. It's not the idea of saving money. It's that, hey, money's a tool. What if we use this to build a website for you and start selling your little bracelets online? So they enjoy the process, and my daughters are very business minded. And every time they come up with something they want to buy, like my daughter's really pressing me for a new iPhone right now. So I'm saying, well, okay, that costs this much money, and there's a monthly payment too. You need to work up a way to create cash flow, and you can work for your money, or we can work on your business. Yeah. So,
and I think that's the appropriate way to do it. I really do. I mean, obviously, we don't want to have our daughters be out there and spending like our wives, but at the same time,
they do listen to this podcast. No.
Men have such a double standard.
I'm gonna pay for that one later.
But here's what the men that I know will do is they'll go buy a $20,000-$30,000 truck, and then complain that their wife spent $200 at Target. Like, To me, I understand. Believe me, we could go down that route. My suggestion is to the three of us to let this topic slide right on by.
You just backtracked out of that. Accept it.
Back up, reverse.
Jeez, really?
Yeah,
oh my goodness.
Absolutely. But no, it's the idea of saving money, and that's the real cost of inflation, is that people who have saved their money for retirement, they're being robbed blind.
Well,
it's
go
a
ask
huge
anybody.
injustice.
Go ask anybody they know that are retired. Do you have enough money to maintain your lifestyle through retirement? How many people you know can maintain lifestyle through retirement?
Very few.
Very few. What, 5-10% maybe?
Well, if you look at the statistics, Matt, the average 401k or the average IRA savings, like retirement for people over the age of 55 and between the ages of 55 and 65 is just $100-something thousand.
Yeah.
So that's the average. And that means, yes, there's some people who have a lot, but that means there's a whole lot of people who have none. And I would say that you have less than 5% of the population.
I mean, in your experience.
So what is retirement, though? I think we live in a new world. What does it mean to retire?
Tim, we only live in a new world because it's forced.
20th century invention. The retirement never existed. People worked from ashes to ashes, dust to dust. They worked until the day they died, or they were cared for. The idea of retirement
by their kids or whatnot.
Right, and so I personally don't want to be retired and bored, but I want to stay active but I don't want to have to go report to some young punk.
Yeah, but you guys,
you want freedom.
Yeah. Right.
Of course, guys, that's great, but you're all in a very different scenario and situation than 95% of the American populace is. 95% of the American populace is tied to this economic reality, this traditional model of which they, like Noah said, they have an average of $100,000, $150,000. And I'll tell you right now, I deal with these individuals on a weekly basis, and that's on the high end. Okay, that's the numbers are skewed because the massive majority control the most money, which means the American populace doesn't have much to retire on. And so when we talk about retirement, yeah, I think people should have a right to enjoy the spoils of their 40 years of work. And I think people should have a right to go golfing when they're 55, 60, 65 years old at 2 o'clock in the afternoon.
Well, the fact is, the older you get, the less employable you become, not because of age, because of attitude.
Well,
you don't want to be told what to do after spending your entire life building up what you've built.
And so technology changes, and they can adapt. And the older it gets, it's hard to adapt to new technological advances and whatnot. And so corporations cut them out.
Absolutely. Well, and we've exported our jobs. The problem with the American economy is just this. We've exported jobs. We are a service-based economy. We don't produce and manufacture. We've outsourced that. Mm-hmm. Along with it, we've outsourced those jobs. And so we have, as a country, and by policy, our policies are essentially unsustainable. And we have this huge shift in demographic that you and I have talked about at great length, Matt, is that you've got 78 million baby boomers coming into retirement, and they're reaching the ages where they get to take their distributions, and then they have mandatory distributions at 70 and a half when they turn 70 years and a half. It's that extra half.
We're now just starting to see that impact in the marketplace.
You have more people pulling money out than you have people putting in, and the workforce
real quick.
Is really shifting. It's an unsustainable model,
Matt. Let's shift that. You mentioned the age of 70 and a half, and I don't think a lot of people understand what happens. You said, for people who choose to pull out and then others who are forced to pull out of the market. What happens when an individual that has a 401k reaches the age of 70 and a half?
Well, they have mandatory distributions. Their money is distributed them. They have to use it, essentially. Mm-hmm. And so they can't keep it in their retirement style accounts. It has to be moved and redistributed and taken. It's like a forced withdrawal. Okay. So it basically takes money out of. And if you were to look at where all the institutions that are out there have their money, well, institutions are all about assets under management. Everybody's been taught to go put your money in a well-diversified portfolio of mutual funds, to have a good, fund manager, a financial planner, and they build these people up and they build their nest eggs. Well, as they start taking their nest eggs out and using it and living off of it, it's a drain on the markets. Money is leaving, and it'll start leaving at a higher rate than money comes in, based off of the Gen Xers and the millennials that are in the workforce now put money in. They don't save. They live hand to mouth. They don't invest. They barely even make their contributions as
Well,
is. In fact, over 50% of people don't even contribute to their 401k plans.
Well, and that's
plans.
getting worse and worse and worse, because as our marketplace evolves from a labor market perspective, it's shifting more to a part-time type scenario than it is a full-time scenario. So that the majority of people out there don't even have a 401k to invest in the first place.
Right.
And that wasn't the case throughout the 70s and 80s and 90s, where you had a majority of the workforce worked, when we had a much stronger labor force. And now we're starting to see that money come out of the market as the baby boomers are starting to come out, reach those mandatory withdrawal ages.
Right.
And there's a massive open question out there: who's going to replace that money? And
that's
we just
where
don't know.
I don't want to make it political, but Mitt Romney caught hell for saying you have more takers than makers. Mm-hmm. And it's not about the politics of it; it's about the math behind it.
Yeah,
that
but
you have
saying
more
that,
people...
Noah, doesn't get you elected.
I know. Well, it's not about getting elected.
Yeah, I know.
I'm just saying. But the idea here is, look, nothing's changed, and we have a shift in population. And there's a great economist. It's Mr. Dent. I can't think of it. Harry Harvey. I get him confused with the Batman villain.
I was going to say Harvey Dent. Isn't that the Batman
Harvey
guy?
Dent. Harvey Dent's Batman, it's Harry Dent's the economist.
Yeah, Harvey Dent is Batman's guy.
Either way, they're both awesome characters.
True.
Harry Dent's big economic studies are pinned down to population growth and population rates, and consumption among American citizens is at its peak for people in their 40s. They're established, they have good jobs, good income, and that's when they're spending. And then as they move into retirement, they live more on a fixed income. They're not in consumer mode. They've already done most of their major purchases. And the real problem, the big underpinning in the U.S. Right now is population shifting, where baby boomers all had huge families. Big average family size.
We came from 7,
5 kids. Now average family size is like 1.5 kids, two kids, and so you have a huge shift in population with people putting money into the system versus those pulling money out of the system. And the only real true fix for the U.S. is an influx of population. And this is where you have some of your burgeoning economies like India and Brazil that are huge. Their populations are growing, whereas the U.S. population is barely maintaining. And with improvements in healthcare and whatnot, life expectancies increase. And so people
aren't going to have more babies here in the U.S. I mean, you go around, you travel as much as I do. 2 kids max, done. I mean, 4 kids. I have 4. Tim, you have 3. Noah, how many kids you have?
Well, and I've got 2, and the more educated people are, the fewer children they have, and that's. I mean, I don't want to sound ignorant or I'm not talking down to anybody, but it's just mathematically a fact that the people who
I thought you were talking down to me. I thought that was like Matt has 4, I have 3, you have 2. You were trying to rank us inversely.
No.
I think what he was saying was I was the highly intelligent one.
Highly intelligent. No, I'm just saying on average, the people who are highly educated, college educated, 2 kids, they're working. Women are in the workforce.
They have a career.
Their priorities are different now. So
also, I mean, you have to have two incomes to survive in a lot of those scenarios. So, having 1.52 kids, but if you're going to have an increase in population, what do you have to also have? You have to have immigration reform. And that's one of the huge things. And so these become political hot points. And you've got your right winger Tea Partiers, your left wingers. Let's everybody get along. And so you're saying we should not put up a wall?
I'm saying that we need a population boom, and bring us your tired, your poor.
I agree with you. No, I am very pro-immigration. Very
pro-immigration. Very, very pro-economy, and I think we need to go back into rebuilding infrastructure, renewable energy, job creation, manufacturing. Not just outsourcing the manufacturing jobs to Malaysia, to India, to places where that you have a willing, eager, hungry workforce. It's a huge shift in economy, and we have kind of shot ourselves in the foot.
No, we have a tendency to offend both liberals and conservatives on this podcast.
I'm an equal opportunity offender. If you are beholden to your party politics, you're not paying attention.
You're just not. You're just not. And I'll tell you right now, you're absolutely dead right when it comes to you have to bring in population. And the only way to do it is through immigration reform, and that's why the majority of economists out there and the majority of Wall Street and traders and out there will support immigration reform. The problem is getting our idiot politicians to actually have the discussion.
Well, yeah. So politics is the other problem we have. Is we have a country, and I think this is a huge thing. You have our policies, and if you go look at the statements by the Fed, by the GAO, the Government Accountability Office, we have unsustainable policies, and you talk about the quantitative easing as a drug, Matt. It is a drug. It is life support. What we need is diet, exercise, and healthy diet. We need as a country, as an economy, we need to be doing what's good and healthy for us, not just putting us on methamphetamines to try to keep this thing alive.
Well, what is good for us as an economy, as a consumer society, is a bubbled burst crash, the pain for 3 years. Is that a good thing for the long-term health of the economy?
That's when some people have been proponents of that, to let it correct itself, to let the free markets actually be free. And the Fed's monetary policy is a way of controlling, and they try to steer it. It's a rudder for the big boat, if you will. So you got this big, massive boat, and you have the policies. They only have two controls. They have interest rates and monetary supply. And then you've got Congress, who's got, they've got tax and spending. And so we've got a taxing spending problem. We've got a interest rate and monetary supply problem. And they're all, until they make changes in policy,
I want to ask you a very pointed question. I'm going to ask you into a very pointed question. Is there a way to unwind the Fed's monetary policy? We can talk about taxes and spending on a later podcast. But is there a way for the Fed, because that's what they're trying to do right now when we're talking about the curtail. They're coming out of the market, but we still have the massive problem of the $4.7 trillion. Is there a way for the Fed to unwind their policy that has been manipulated for 5 years? Now, remember, the Fed never purchased a bond. They've purchased $4.7 trillion now. Can they unwind this? Matt? Yes, I can hear you. But can they unwind this without causing a massive sell-off?
Yes. Of course, I don't think it will work out that way, but yes, of course they can. If you're not open-minded enough to consider all potential scenarios, I think there's a scenario where it plays out into a Goldilocks economy, and it depends on how you define massive sell-off. When I think of massive sell-off, I think .com bubble crash. I think
that's what I'm referring
real
to.
Estate bubble crash,
some prime
50-60%, something like that.
Yeah.
Well, okay, yeah. I had some minor technical difficulties.
I got you back, Noah.
Yeah. So the question was?
The question is,
can they steer us out without an economic crash?
Can they unwind both their quantitative easing as well as their $4.7 trillion while increasing interest rates without a panic sell-off?
Well, that's the greatest question of all right now: is can they manage it? Can they keep these balls in the air juggling it? Not without significant changes to policy. And so that puts it back onto our elected officials, our representatives in Congress. The Feds can only do what they can do, and by themselves, can they steer us out? I doubt it. Mm-hmm. Can they, with the help of policy changes, steer us out more safely without a crazy crash? Potentially, but it's going to take a collaborative effort. And the problem is people are unaware of the problem. It has been a pay no attention to the man behind the curtain as they're trying to keep this thing afloat, because nobody wants it to go down on their watch. No politician wants it to go down on their watch. No Fed chairman or chair member wants the economies to go down on their watch. So they keep kicking this can down the road in hopes that the next guy in office or the next guy at the chair, the next person at the chair is going to take the fall. And I think the biggest problem we have with this right now, Matt, is, and this is something that you and I have again talked about at length, is they're out of bullets. They can't lower interest rates any lower. They can't go zero, can't go negative.
That's my biggest thing, guys. Right there.
They can't just keep printing money without the cost of hyperinflation. And so in my mind, if you go back and you study the crashes of 2007 and 8, 2001, 2002, they were able to prop the markets up with monetary policy, interest rate cuts, and stimulus package. So 0102 interest rate cuts, which led to the nice growth, but it also led to the
interest rates and stimulus
subprime
packages.
They overstimulated it by making money too cheap and easy. Well, then as that was crashing, you had the two largest interest rate cuts back to back, and then the bailout. And these are unprecedented events. But now they're at a point where the market's running up. But is this growth sustainable? And are these numbers real? So we come back to our question of GDP. Did we actually improve our GDP to sustain the values? Are the companies in the S&P valued fairly? Are their earnings? We're in earnings. They're announcing Amazon, the largest online retailer, missed earnings, but they pointed to their raise in costs of operation, their increase in cost of fulfillment, increase in costs of shipping, increases, and so their bottom lines are getting trimmed because cost of living, expenses, operating a business is going up. And so, that's a real sign to me that the economy they're not necessarily giving us the big picture.
Well,
so and then to answer the question, I think that once it starts going down, we are poised for, I think, the biggest correction in market in the history of the world.
I'm going to tell you right now, guys, we've been talking about that question for about 3 minutes, and all of us kind of have the same take on it. But I'll tell you this, that is a lot of ifs that have to come together and a lot of hypotheticals that have to come together for this market not to crash. Okay, that just, to me, I do not see that happen. I do not see the private sector. I do not see the public sector. I do not see the government. I do not see the Fed cooperating to such a level that they have to give back enough in terms of, their base for this to actually be unwinded successfully. And I agree with Noah. I think it's going to be the largest crash we've ever seen in American history.
Well, which for our audience should be exciting because we know how to play the market.
Yeah, just buy put options.
Yeah,
it is. And I'll tell you, I will push back on it for a second because I remember when the markets were crashing in 8 and early 9, I thought the problems were so bad they couldn't even fix them. And I don't think they've fixed them. I think we've talked about that at length in this podcast today and as well as but they addressed them. They at least got
but that
back.
was after the crash had happened, and they had ammunition to fix them. They hadn't printed money. They had never purchased a bond. They hadn't bailed out the problem. They had interest rates to cut. And even Alan Greenspan has acknowledged the massive problem with raising interest rates in in what is most likely a bubble. How do you fix the problem if it does start crashing, T?
I'll go back. Well, I have some opinions on this, and I'm not afraid to share opinions, but I am.
Well, of course not.
I believe in the idea that you examine all sides of an issue.
Mm-hmm.
And I'll go back to what what was his name, Trouble or Schlubble or whatever.
Schwabble.
Whatever. I still can't say it right. Where I'll take
German
issue
trouble. I did it for you. I gave you a German accent.
You're going to be our voice guy. I like it.
Oh, man, we need to cut that one out. That's going to be a plug from here on out.
No, it's beautiful. He used the word clueless, and I don't agree with that because these policymakers aren't clueless. They're just puppets. They're making these decisions, even though they might know from economic theory. I don't think Ben Bernanke's clueless, Matt. I don't believe that. I mean, the guy's Ivy League educated. He's been around the market. He understands economics. He just had to make these decisions, whether it was political driving him
I disagree
or his
with
old
that.
buddies on Wall Street or whatever it is.
He did not have to do that. He did not have to prop the market open. He did not have to print billions of dollars, trillions of dollars. Even when you look at the Fed itself, Fisher from the Dallas Federal Reserve came out in 2011 and said it hadn't worked. Fisher, a federal central bank president, said it hadn't worked. He wasn't a voting member. He's a voting member now.
That you want to go golfing with. What do they vote for? Like even right now, you had some dissenters.
Fisher's a voting member now. He was not back then.
But their hands are forced. They only can play the hand that they're dealt. And even though their policies and thoughts, they say, "Oh yes, I want to see it this way," but then they have to vote for the stimulus to keep.
The central bank is not a public entity; it's a private entity. It does not have, or it should not have, any political influence on it. I don't buy the excuse that they had to bail out the banks. I think that goes against every free market capitalistic principle that I have. You bail out one bank, guess what the next bank does? The same bullshit problems that the first bank did. You let those bastards. You let those bastards.
We allow some cussing. We call this
cussing? All right.
A PG-13 podcast. I really argued for R, but Matt has, he's got common sense ability.
So if you guys could send me a list of approved words, I'll go ahead.
Well, with Dean Beckett, Dean, he's my mentor. He dropped the F-bomb on here. Listen, the one thing I think people like about the podcast is we're us. We're real. We're real traders. We're not going to have Fed speak. We're not going to pull punches. We're going to say what we think. We're going to disagree sometimes, but we're going to speak our truth. And I'm going to tell you right now, the Federal Central Bank made a mistake by bailing everybody out. And they made a bigger mistake in 2011 when they started quantitative easing. 2, when quantitative easing 1 had obviously failed. And they made even a bigger mistake in September of 2012 when they announced quantitative easing 3, simply to prop up the markets. The free market can handle a bear market. American consumers can handle pain and anguish. But you know what we're going to do? We're going to tie our laces up a little tighter. We're going to go get the job done. But they made such a massive problem with it that they are literally causing hyperinflation out there. And there is nothing we can do about hyperinflation. Germany calls it clueless because in 1914 there was a 4 to 1 mark to dollar ratio. In 1922, after the Versailles Treaty, after they printed money, after they put the debt on Germany, after the economy was in shambles, it was 2.3 billion to 1, and then it ultimately led to 4.3 trillion to 1 German mark to US dollar ratio, where their currency was completely and utterly worthless, and they had to kill the German mark. And I know that was in 1922, but we've only seen about 25 other hyperinflationary scenarios in the last 20 years alone.
We've seen, you could take and go study some economies and countries that have had currency resets. And you go back and look at countries like Brazil, Argentina. Like Argentina is currently in default. They are at the point where, yes, they got to the World Cup championship, but they're not only did they lose the World Cup championship, they are going into default as a country. And
well, we saw what was happening today.
Their peso is going to fail.
It's gone. It's going to be done.
That's what is the question. I think the big thing we're talking about without actually saying it is the death of the dollar, the petrodollar, and the potential risk of our currency completely collapsing in a global economy where people have a choice of what they want to get paid in. Do you want to get paid in euros? Do you want to get paid in Bitcoin? Do you want to get paid in Chinese yuan? What currency can back, what is it backed by? Well, and in the world of fiat currencies, it's all just a social agreement anyway.
One of the reasons the Fed started doing all this, guys, is because they wanted to devalue the dollar. That's what one of their stated goals was. They came out a year and a half ago and said they wanted to devalue the dollar by an additional 30%. So our imports are cheaper to buy from foreign countries.
Right.
And that's
a silver lining spin, in my opinion, because do they really want a devalued currency or they want a strong currency? You want a strong currency.
For a healthy economy? Absolutely.
Yeah, it's like saying, well, yeah, I mean, sure, I'm fat, but delicious dessert is awesome. So it's not good for us, even though you could say, well, I'm happy because of it. Mm-hmm. That's the thing is the dollar, and I think that the currency change it's almost a foregone conclusion at this point in time.
Well, just recently, okay, for everybody that understands this, the foreign exchange is international trade, and $4 trillion US dollars are used in international trade every single day. It currently represents 60% of the reserve status out there. Now, just recently, okay, every country in the world wants to move away from the dollar as a reserve, by the way. Just recently, you had the BRIC countries create their own World Bank. What does that tell you guys about where the international market is moving from a currency standpoint?
Well, that's what you're really looking at. This is the kind of thing that is hugely. This is basically a global power struggle that's always been going on, and it's like the Cold War never truly ended. It just moved from arms race to economy race. And you have the 16 major central banks, and those who are not on the central banking system are considered the axis of evil. They're the countries that don't kowtow to the central banking cartels. Mm-hmm. You get those countries like China and Brazil and Russia, etc., the BRIC countries. They don't want to play the game by our rules. They don't want to pay the U.S. middleman for the petrodollar. They want to have their own economic system that's independent of the existing. So I get that. It's literally saying we don't trust this system.
If we were running India or China or Russia or Brazil or South Africa, we would be doing the exact same thing, guys.
Right.
I mean, why would they pay the middleman if you can go straight to direct? And so when I start to see these scenarios play out, and this was just last week that the BRIC countries created their own bank, and they were going to start. It's like a World Bank, how we created the World Bank back in 1944.
Yeah.
It's basically what they did currently is they just created their own banking system that they're going to be utilizing. And they came out with the headline and said, well, we want to work in conjunction with the IMF and the World Bank, but we are a sovereign entity in its own right. And if you add up the BRIC countries from a GDP perspective, they're actually larger from an economic standpoint than the U.S. is.
Oh, absolutely. In fact, it's this is kind of these moving parts. It's a big, giant game of chess, and you kind of have to take a look at the big picture and think these moves ahead. This is the other reason it's the Bitcoin is in the cryptocurrency has been created is because there are people who want to circumvent the current
traditional
banking monetary
central
system
bank model,
because
yeah.
they see the systemic risk. And you have to go back and just look at, it's been a year now or so, but since we were talking about bank failures and things in Greece going down and whatnot, there's contagions and the debt ratios out there are so large that it's entirely possible that the banking systems can collapse under their own weight.
And that's just what I'm talking about. When we look at the macroeconomic risk out there, I do not currently see a scenario where the U.S. central bank can both stop quantitative easing, unwind a 4.7 trillion balance sheet, and raise interest rates without causing some degree of market reaction. Whether that's 20, 30, 40, 60%. Nobody wants to say for certain. And guys, you always want to trade with your eyes and whatnot and so on and so forth. But you also want to prepare for that.
Well, and that's why we come back to what we were talking about earlier, watching the Fed's announcements, the GDP reports. These are the things that start those movements, and we want to stay on top of it as traders and technicians. Just like you say, trade what we see, not what we believe. And I don't know. The truth of the matter is none of us know the outcome.
No.
All we can do is see the signs,
Everything's
read the charts.
based on probabilities anyways.
Exactly.
Yeah.
So we just read those charts and stay on top of it, and that kind of takes the guesswork out of it for us, where understanding the underpinnings and the economics and the fundamentals of economies and global, the global scale of everything is to basically understand the why things would move. And then the market's technicals is going to be when, timing, confirmation, triggering. Mm-hmm. For now, we're in a bull market. But at what point in time does that optimism fade?
Yeah. Well,
hold on a sec. I want to do the plug, and then I have an opinion on this. You're gonna get. Let me. I got a good plug lined up in my head. I want to see if I can actually execute it. You ready?
A good plug never. You don't announce
Did I get a drum roll?
I don't know. I might need a drum roll. Okay, you're listening to the Trading Justice podcast brought to you by TackleTrading.com. Come and watch our coaches show. Check out our newsletter and blog, videos on all kinds of trading content featuring opinion and articles from our coaches. The Trading Justice podcast features Matt, myself, special guests, Noah Davidson, and Gino Poor. TackleTrading.com. Take control of your financial future.
Oh, Lord.
You need background music for that.
Need
That was
background
awesome.
and a little lower in the voice. Give me a little lower voice. Let's
well,
practice
here's the
that
problem.
Again.
I'm still trying to figure
serious.
the
I want
audio
some
out.
practice right
You
now.
tell me I'm loud.
Give me the.
But then I listen back to the podcast and my
Give me one of
audio
these.
sounds light.
Give me one of these. You're listening to the Trading Justice podcast presented by Tackle Trading.
All right.
Give me one of those.
What time are people listening to this? 2 in the morning or 2 in the afternoon?
Dude, you never know.
Do I need a 2 in the morning voice too?
No, I need
some Barry White in the background.
Barry White, man. That's
yeah.
Hold on.
I'm down with
Hold
that.
on. Wait a second. I think we got something.
We need a
going on
bass
here.
track. Is what we need.
Here's my opinion, Matt, and I've been listening, and I'm a very good listener. I pride myself on that skill. I think that you guys are dead on, but I do think there's a part of this discussion that we're not addressing. And that is the difference between what is and what should be. Because you're very passionate about what should be, but that may not accurately reflect what is. See, that's where I was going back to the guy from Germany, and I don't want to pronounce his name wrong again,
Schwabel.
where calling Bernanke and those guys clueless, I think, is wrong. Because it assumes that we do live in a free market. Now, I'm not saying we should not. I might agree with you, Matt, that we should just live in a free market. They should back away from it. But so many of these decisions, whether we like it or not, are tied to special interests and politics and Wall Street and investment banks. And Bernanke's just a puppet on a string. All these Fed guys are. Do we really think Janet Yellen is leading the free market into a new age? I mean, come on.
Well, is she
Who
single?
believes that?
And is she on Match.com?
J-Date, I think.
J-Date, our time, whatever it is. I agree with you, Tim. I mean, and we kind of keep going in circles. If we don't watch ourselves, we will end up talking for the next 3 hours, 6 hours, 10 hours. We don't stop. Once you start getting onto things like monetary
This
policy,
will become the longest podcast in human
history of podcasts.
Yes,
yeah.
yes.
But I think that's because we are passionate about it, and the reality of it is okay, we look at these. This is information.
Yes.
Systemic information. We got the economies of scale. We have to look at it from a big global picture. The real thing that we offer is a solution. It's the action. Take action. When in the plug, Tim, you say take control of your financial future. Well, in a world that has an uncertain financial future, what can you do to prepare and to profit from it, to survive it, and to provide and take care of your families, and to take care of the people you love? Because that's really what matters at the end of the day. Is what can I do with the information I'm given?
We constantly say we're CEOs of our family, and our responsibility as the CEO of our family is to provide for our family. And that's what being a trader allows you to do, regardless of what the market does. If the market goes down, all three of us will be happy because we'll buy put options, right? But if the market goes up, we're going to continue to be buyers, and it is a bullish market right now. But I will say this. I do not think Janet Yellen, Ben Bernanke, Alan Greenspan, I do not believe they are dumb individuals. They're some of the smartest individuals out there. Okay. I also believe that all three of them are tied to the Ayn Rand bubble type economy, to where they believe in bubbled marketplaces, and that hurts consumers. I also believe that Janet Yellen has friends, and those friends are not Tim Justice, Matt Justice, and Noah Davidson, or our parents, or our brothers and our sisters, or the people we know. Their friends are the friends on Wall Street, of which they give Wall Street an opportunity to get out before the tidal wave, and I think that is harmful.
So you're saying I don't have a chance with Janet Yellen?
You're a good-looking man. I mean,
and is it Yellen or Yellen? I do not know.
I would say Yellen. Okay,
but
I'm looking at your picture on Skype right now. That is
depends on how the date goes.
Smile.
I think, Noah.
True story. If I buy her dinner, I think we're set. If I pay for it in a cryptocurrency, Bitcoin, I think that
we'll do a Bitcoin podcast. Yes, absolutely.
We did a Bitcoin. We had podcast number 2, Bitcoin, but let's do another one because I think it's such a hot topic.
Why don't we call this one alternative currencies instead of just Bitcoin?
No,
because I think
like
there's
Bitcoin.
A lot of other, niches in there. We could do another currency podcast, Matt.
I think it'd be great.
I think we should do it. I think we should do a podcast specifically on the current currency system and the evolution of the currency system as we see it.
I would love
that.
to bring
You have
Jeff
to plug in Forex. We have to talk about solutions for it and taking advantage of these things.
Well,
it comes down to can we profit and can we thrive in this situation.
I would love to bring Jeff on, but I would need a mute button. Like on that show Around the Horn.
He needs a mute button.
I would need to be able to mute him. But yes, I would love to have Jeff's opinion on some of this stuff too.
Well, and some of the stuff Jeff is doing in the currency market right now. For those of you who don't know him, Jeff Crystal is pretty much all three of our Forex mentors and technical mentors and whatnot. He's an absolute wizard at technical analysis and Forex trading. But some of the stuff he's doing from a technological standpoint is just off the hook amazing. What he's doing with those FAT tools, the Forex assisted trading tools, and what Rich Dad from a high level is doing from a currency system and whatnot, it's really quite evolutionary. I love it.
Mm-hmm. Yeah, let's wrap this puppy.
Well, okay.
Final thoughts, everybody?
Noah Davidson.
My final thoughts are...
By the way, we did not get into employment.
Learn how to cash flow, and most importantly, learn how to keep your money safe. We've, Tackle Trading, it being the sponsor of this podcast. We've got, now, is that our background music, Tackle Trading?
Yeah, keep going, buddy. Keep going.
It's about taking control and knowing what to do and when to do it so that you can practice, train, and understand that there are ways to profit. There are ways to cash flow, make money out of the financial markets, whether it's trading stocks or options or futures or foreign currencies. If you are proactive and you learn how to take control of these things, in essence, tackle trading, tackle investing, tackle your life and take control of it, make sure that you're staying on top of these things, and come visit us. We're forthcoming. TackleTrading.com is almost ready to launch. Not quite there yet, but we want to see you there. Sign up and get this information in bite-sized quantities all the time.
Awesome.
Matt,
Tim,
I'll let you do the final one, so I'll go in the middle. And you got a song lined up?
I
do. Got a song for
I
today?
do have a song lined up, and Noah has said that he will be singing the song.
I might have to listen to that.
Yeah.
I have two final thoughts. Number one, social media follow of the week. If you don't follow him, go check out Snoop Dogg on Facebook or Twitter. It's good for at least a laugh a day. Amazing videos he reposts
Plug in
on there.
Snoop. Love it.
Snoop Dogg is great on there. In terms of all of this stuff, guys, my opinion is that you want to surround yourself with people with experience and success in business and life in general. You don't have to figure the world out, but it's good to get connected to how the economy works and why it moves and all this type of stuff. I wasn't trained formally in economics, Matt, and I don't ever try to pretend to be. I've been a trader every day for the better part of a decade now, and that's how I learn it. I like to call it, a street smart
hands-on
economic education.
Practical application. I like it.
I just, it's okay to disagree. It's okay to have opinions. But remember, the most important thing is what Noah said. Take control. Take control of yourself. You don't want to be dependent on whatever happens, so that if this thing spins out of control and goes into a bear market, like many of us think is very highly likely at some point in the next 12 months or so, you're ready to capitalize. Like Noah said earlier, traders love that stuff. They lick their lips over that kind of thing. So just be ready for it. Have some fun with it. And thank you for listening to the podcast. Go check us out on iTunes. Give us a rating and give us a review. Like Matt, we did earlier today. I love the segment that you thought up and the student email segment, the question. Post something on our forums and we'll be happy, or Facebook page, either one, and we'll be happy to talk about it in a future podcast.
Thank you, Eduardo and Todd, for sending in those questions. My final thoughts is this, guys. From an American consumer, I'm very passionate about what the Fed is doing, because what I see them doing is, number one, putting immense pressure on the dollar, putting immense pressure on the international forex community to shift away from the dollar as a reserve currency, in the same capacity that in 1999 we shifted away from the petrodollar. We're at the beginning of the death of the petrodollar, with Russia and China moving away. And I see what the Fed is doing as tying themselves to Wall Street as killing the American dream. For the American dream is basically, we have many different definitions of it, but one that I've always found true is that every generation will exceed the prior generation. And since Thomas Jefferson wrote that great Declaration of Independence in 1776 and our Constitution in 1787, we have done that. We have exceeded every generation until my children's generation, and that makes me sad. And so I feel I love our country. I love what it represents. I love being an American and being from the U.S. But I also feel sad for my children who are going to grow up in a different environment, a different economy, and a different political scenario than what we were raised in. And so I do feel for that, and it does make me sad. However, as a trader, I could care less. As a trader, we trade what we see, and if the markets go up, we buy. If the markets go down, we sell, and we go make a lot of money into it. That is my final thoughts.
You've been listening to the Trading Justice Podcast. If you've enjoyed yourself and think that the conversations and topics we've covered are important, help spread the word. Give us your feedback. 5 stars on iTunes, like us on Facebook, and follow us on Twitter. The Trading Justice Podcast is proudly sponsored by TackleTrading.com. Get off the sidelines and get in the game.